This podcast is intended for investment professionals only.
So hello, and welcome to this edition of LGIM Talks. I'm delighted to be welcoming back James Carrick to the podcast. James is a global economist in our asset allocation team, with a particular focus on the US, UK, and European economies. My name is Anthony Penson, and I'm an institutional content manager here at LGIM. Today, we're going to be discussing the rise in UK interest rates and the implications for both businesses and households. Having been the first major developed world central bank to raise interest rates in the aftermath of the COVID-19 pandemic, the last 18 months have seen the Bank of England deliver no fewer than 13 consecutive interest rate rises, from 0.1% to today's rate of 5%. So given this background, James, I wonder if you could begin by giving us some of the reasons behind these rate rises and why the Bank of England has been under pressure to act like it has.
Thanks, Anthony. Of course, initially the economy was recovering from COVID, so it was just a normalization of interest rates. But remember, interest rates were very, very low in the previous decade or so. But then we had a lot of inflation as we recovered from COVID, and there were shortages of goods in particular, and excess demand for goods from the US. But then more powerfully, we had the conflict in Ukraine, which pushed up energy prices in Europe and food prices in Europe. And the Bank of England is acutely aware of the risks of second round effects, whereby companies don't want their margins to be squeezed, workers don't want their real incomes to be squeezed. And so everybody is fighting to pass on that little bit extra, a wage increase or a margin increase to ensure that they don't suffer a reduction in their living standards. And so the Bank of England has to snap that wage price spiral out of the system.
Thanks, James. That's a really useful background. So perhaps now, please could you outline the impact that these rate rises are having on UK businesses and how that compares to previous rate hiking cycles?
Yeah, businesses seem to be the most vulnerable part of the economy. We're seeing corporate insolvencies in the UK running at about 2,300 per month. That's very similar to what we saw in 2008, the GFC recession, and also 1992, which was another big interest rate hike cycle recession. Raising interest rates to double digits to stay in the exchange rate mechanism. So the number of corporate bankruptcies is extremely high and really at recession type levels.
So what's the reason, do you think, for the fact that businesses have been so affected this time around, despite the fact that so far at least the UK economy has avoided recession, unlike in both 1992 and 2008?
Yeah. We need to be careful there's not funnies driving the data. So there could be a catch-up of insolvency cases from the COVID era. The courts were closed and banks were encouraged to give forbearance to companies to allow the economy to withstand the COVID shock. So we could be seeing just a backlog of businesses that should have been made insolvent during the COVID period, but are now just finally going through the courts and getting it signed off. Having said that, in the United States, where the courts were not affected by COVID, we're also seeing bankruptcies rise, again, consistent with previous recessions after the dot-com, after the GFC. There's a new ticker on Bloomberg, BCY Go. They've got a proprietary database of their own recording when companies are going bankrupt. And so we're seeing this pattern, not just in the UK, where there might be some funnies, but also in the US, where those funnies might not apply.
Thanks for talking us through that, James. I can see it's particularly interesting how the effects are different this time around, given the impact of the court hearings in COVID, which was obviously not the case in previous hiking cycles. Perhaps now if we could move on to what you see as the effect of these rate rises on UK households so far, and also then what the outlook for UK household finances is over the medium term.
UK households are more insulated from interest rate increases than ever before. And that's because a greater share of households have their mortgages fixed than in previous cycles. And not only they're fixed, but they're fixed for a longer period, not just say 2 to 3 years, but increasingly for 5 years. So in the old days, when the Bank of England raised the base rate, we used to get a letter from our bank a few days later saying your mortgage payment's becoming more expensive. These days, it's only an increase in your interest payments when your mortgage has to be refinanced. And so what that means is it's taking a lot longer for the pain of higher interest rates to be felt for the household sector. And so to implement the same amount of tightening squeeze of household budgets to reduce spending in the economy and to reduce inflation, the Bank of England is having to raise interest rates aggressively to really hurt those unfortunate households who are having to refinance, because it can't really hurt those households who still have a long term left on their fixed rate mortgage.
So far, it seems that the UK housing market relating to that is muddling through, but I wondered if you thought if that was still likely to continue to be the case, or if there's something else we should be thinking about regarding the UK housing market, given the effects you talked about.
Yes, so when we think about the housing market, we think about demand and supply, and prices and activity will be determined according to that. So given the rise in the cost of a new mortgage, we know that demand has collapsed. There's very few transactions taking place. But in terms of supply, there's very little supply coming onto the market because apart from the usual deaths and divorces, the other two reasons for a house to come onto the market is unemployment going up, which we haven't yet seen, and also the interest burden is becoming so unbearable that you're forced to sell to trade down to a cheaper property. But because the pain of the interest rate hikes is taking longer to be passed through, we haven't yet seen the same supply response that we'd normally have at this stage of the interest rate hiking cycle. Now, we think it's a matter of time. We think that the pressure will mount increasingly on the supply side of the housing market as those refinances come through at increasingly higher rates, because obviously the Bank of England is still raising interest rates. And therefore, although house prices have modelled through perhaps better than feared thus far, we think there will be continued pressure on them as that refinancing cycle continues.
So how does the debt profile of mortgages compare to those of bank loans for businesses? And what could this mean for the UK corporate sector?
So we think that businesses are more sensitive to changes in the base rate than households. So our analysis and the Bank of England's analysis shows that of the increase in the base rate, only about 30% of that has been felt by consumers because a lot of them have these fixed rate mortgages. But about 80 or 90% of the pain has already been passed through into bank loans to the corporate sector, because for companies borrowing from banks, particularly small companies, they're mainly floating rate or at most fixed for 1 year, so they're much quicker to feel the pain of the higher base rate.
Given this backdrop of differing effects of rate rises on UK households and UK businesses, what does this mean in terms of the overall outlook for the UK economy?
I think that it means that the economy is still vulnerable to a recession, still vulnerable to a self-reinforcing downward spiral of banks tightening credit conditions, making it difficult for the economy to grow, which in turn, pushes up unemployment, reduces investment, reduces consumer spending, and becomes self-fulfilling. And that's because although the housing market is muddling through in terms of house prices, we are seeing these rising bankruptcies. So I think that the corporate sector is feeling the pain. And I think that banks will react to that by being cautious about lending. And that is traditionally the start of a self-reinforcing economic downturn.
Thanks, James. I think that's pretty much all we have time for today. But before we sign off for this podcast, did you have any final observations that you wanted to mention about interest rates in the UK more broadly?
Yes, so in terms of the interest rate sensitivity of the corporate sector, one area we've been looking at is what's called non-bank lending or private credit. So lending to corporates not done by the banking sector, but maybe through an insurance company, maybe through an investor into a collateralized loan obligation. And what we find is that these are also tending to be variable or floating rate interest rates. And the size of this market and the size of the leveraged loan market has actually grown to be similar to the high yield bond market. So the high yield bond market, those interest rates are fixed until the loan is refinanced. But these private credit and leveraged loans, they are floating rates. And I think that because interest rates are going up, these companies are under stress. So I did see a report recently, and they showed about 1 in 7 companies were struggling to cover their interest payments a couple of years ago, and now it's 1 in 3. And if the Fed funds rate remains at 5.5%, then they estimate 50% of companies will struggle to cover their interest. So I think that the corporate sector really is the weak spot in the current rate hike cycle globally.
That's great. Thank you very much indeed for joining us today, James. And thank you also to you at home for listening. If you'd like to read more about this topic, then head over to lgimblog.com, where James has written more about the effect of interest rate rises in both the UK and the US.
As a reminder, this podcast is intended for investment professionals only and shouldn't be shared with a non-professional audience. This podcast should not be taken as an invitation to deal in legal and general investments. Any views expressed during this recording belong to the individuals and are based on market conditions at the time of the recording and do not reflect the views of Legal and General Investment Management. Forward-looking statements are by their nature subject to significant risks and uncertainties and are based on internal forecasts and assumptions and should not be relied upon. Where individual stocks are mentioned, these do not constitute a recommendation to buy or sell any security and are for illustrative purposes only. Legal and General Investment Management Limited is authorised and regulated by the Financial Conduct Authority. For full terms and conditions, please visit our website. To find more content, you can check us out on Twitter, LinkedIn, and our website. Copyright 2023. Legal and General Investment Management Limited. All rights reserved. No part of this publication may be reproduced or transmitted in any form or by any means, including photocopying and recording, without the written permission of the publishers. This material is issued by Legal and General Investment Management Asia Limited, the Licensed Corporation BBB 488, regulated by the Hong Kong Securities and Futures Commission, for professional investors only.